Hello, Dan. So tell me, what's your perspective on the recent global rally?
Well, I think it's been, very satisfying to see the returns for the most part that we've had year to date. It seems that getting past the fiscal cliff in the US maybe psychologically had a pretty good impact on investors. You've seen a lot of cash coming in to mutual funds and also a pretty good rally in the markets. It may soften a bit. There's still problems that lie ahead, of course. You still have the Italian elections, of course. There are things going on in Spain. I'm not quite sure how the political scandal there might evolve. But broadly speaking, I think if you focus on fundamentals, the outlook for equities is still good. So I think over the course of the year, you're still going to see appreciation.
And is it a real rally? So in other words, do the fundamentals justify it?
Absolutely. I mean, there's a couple of things you want to look at when you want to evaluate an investment in equities. First off, you need to look at valuations. You don't want to overpay. And valuations today are still good. It's certainly below average, so there's room for further appreciation there. The other thing you need to look at is earnings growth. And they're maybe a bit challenged, but still positive. So broadly speaking, you should still get earnings growth. You've got potential for valuation. So there is definitely fundamental reasons for the market rally to continue.
Now, there's three big places that everyone's talking about. There's the Eurozone, there's the US recovery, and there's the Chinese soft landing. What's your perspective on all of those?
Well, certainly these are the topics that have been on people's minds for quite a while. I think though both will hopefully fade in significance over the course of the year, because I think for the most part, they're all going much better. For Europe, I don't think too many people really worry about a breakup of the Eurozone at this point. There's certainly economic challenges, but that's something that I think we can manage. For the US, we've gotten, so to speak, away from the edge of the fiscal cliff. There's a few deadlines ahead that still have to be dealt with. You may see some volatility in the markets around that. In particular, next month, they still have to make some decisions on budget cuts. But I think as you saw in December and January, there will be some type of compromise and things more or less will progress as they should. And then finally for China, the important thing to keep in mind is that the economy actually slowed down to the greatest degree last year, and it has actually been recovering for the last 3 quarters. So the hard landing, soft landing debate for China is to some degree old news, even if that hasn't filtered out into the wider public yet. And growth seems to be steady at over 8% right now in China.
Everyone seems to be warning about the risk of losing money in what we used to call safe haven assets. What's your view on this? And also of the inflation risk to bonds in general? Sure.
Well, I think the two different things for people to think about, because the risks are going to come from different areas. I think for people who bought, what we'll call safe haven assets, be that gilts or linkers or bonds or treasuries, anything like that, I think there definitely is a risk that from today that those yields are going to go up, which means the prices will go down. Yields and prices move in opposite directions for bonds. And we think that with the generally improving outlook in Europe in terms of worry about the Eurozone as a whole, that should allow yields to go back up. So I think that's a very valid concern, and people should be thinking about taking money that they have currently invested in those types of assets that they might have in money market funds or in their current accounts, and moving that into riskier assets such as equities. I think the worry about inflation is a little more challenging. Certainly within the UK, without question has an inflation problem. I mean, if you think that inflation's 2.7% or so, even when you've had very weak economic growth, that suggests there is a structural problem within the UK. So again, investors probably should, one, look to equities because that's one of the natural hedges against inflation, and also be looking abroad because inflation is not as much a concern outside of the UK.
Now, there's a lot of talk about the great rotation, which is underway. Should investors be rotating themselves?
Well, it's been a mystery a bit over the last couple of years. Retail investors typically are accused of following the markets, that when they go up, then they'll move money in, and when they fall, they'll move them out. And they've done that for previous bull markets and then bear markets, but not this time. Since March 2009, global markets are up over 100% since then. But for the most part, you've seen redemptions from equities for a good part of that period, which is a bit of a mystery. So finally, it seems, again, this may be a psychological change between things looking better in Europe and avoiding the fiscal cliff in the US. People now finally do seem to be moving into equities again, not putting quite so much money into fixed income, and also taking money out of money market funds. So far, with the data we have year to date, it does look like this great rotation that we've been expecting and waiting for is taking place, and definitely is positive. I think, fortunately, people haven't waited too long. Even though there's been this very good rally, there is still potential for further returns in equities. Again, going back to the point about valuations and earnings are still good. So it is a time that people should be moving, but people don't want to wait too long. If you wait until everything looks rosy, of course, by that point, markets will have already rallied.
There's been a lot of talk and a lot of headlines about currency wars. What do you see as the risk of competitive devaluations? Haven't we already had them? And what does that mean for portfolios?
Well, I'll answer that in two parts. One, what does it mean for portfolios? I mean, it's a broader question of how an investor thinks about exchange rate risk. Do they want to buy portfolios that are hedged into sterling so they don't have to worry about currency changes, or do they want to allow themselves to take the risk, which means there's potential opportunity if you purchase assets in foreign currencies? So that's a much broader portfolio decision that really doesn't have too much to do, I don't think, with what's going on right now. It's a very long-term, broad allocation. I think currently with currency wars, I think it may be a bit exaggerated. I don't know if that's necessarily an apt term for what's happening right now. I think what really is going on is you do have quantitative easing in the US and the UK, so that definitely does have an effect on the currencies, but that's not the point of the central bank intervention. They're not trying to change the value of the currencies, to some degree perhaps in Japan, but ultimately the value of currencies are determined by market forces. Really, a central bank cannot over the long term change the value of a currency. The markets are simply too big. So yes, we might have some short-term volatility now, but long-term markets are going to follow fundamentals, and that's what really investors should focus on.
Thank you, Dan, for talking to Mindful Money today.